Depreciation is such a powerful part of housing. And it's one of those areas where, there's so many components to the deals that we do that depreciation is often left unaddressed. And I wouldn't say that we wind up with unintended consequences, but we don't wind up with purposeful results.
Welcome to Buzz House, a Baker Tilly podcast where you can find all the buzz around multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Garrett Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Each week, we'll bring you a guest or a topic in the multifamily housing industry that will help you win now and anticipate tomorrow. Let's get started. Today, our guest in the Buzz House is Chase Inda, a partner of ours at Baker Tilly who focuses on real estate and construction tax strategy and compliance. We'll be talking with Chase today about some tax efficient strategies based on current, expiring, and projected tax policy. Before having a discussion with Chase about these tax topics, I want to give you a few updates from around the industry. HUD just came out with its operating cost adjustment factors, or OCAF, for 2021. These are, of course, the percentage rent increases for project-based assistance issued under Section 8. We'll have this Federal Register notice linked at our podcast site for you to review your specific state. The national average OCAF for 2021 is 2.5% compared to 2.2% for 2020, with a low of 1.8% and a high of 2.8% for a number of states. So again, look at our link to find that information. Also, we touched on the light tech industry's needs for additional extensions due to delays because of COVID. 140 companies signed on a letter to the IRS applauding the IRS for Notice 2020-53, which gave extensions on 10% tests due and some other deadlines, but urged the IRS to make additional extensions. Specifically, this letter called for the IRS to extend the December 31st, 2020 deadline associated with requirements for 10% tests all the way through September 30th, 2021 at a minimum. So giving those that had a 10% test due between January 1st all the way to September 30th, 2021. It's interesting. We're definitely seeing a lot of things moving in the industry, but there are certainly projects, if it's personnel delays, materials delays, and so forth. So still a really big thing. The other big thing that, in addition to what was mentioned in 2020-53, and many people are really asking for the IRS, is a 12-month extension for the place and service deadline. We definitely know that maybe projects got a late start in closing, have construction delays, again, because of either personnel or other activities that really are finding a crunch here coming to the end of the year to meet their place and service deadline. There are some other revenue procedures out there which actually do allow extensions to that hard place and service deadline, but that relief requires specific action by the state housing credit allocation agency to approve those. So really the industry is looking for industry-wide extensions that are just, kind of flat across the board. So definitely stay in touch with your lobbying groups, your senators, even talking to your state agencies about how we can all move forward as an industry to move these forward. And with that, I'm going to turn it over to Garrick and jump into our discussion with Chase Inda. Garrick?
Thanks, Don, and thanks, Chase, for joining. By the way, audience members, Chase is one of Baker Tilly's brilliant tax minds, and he and I were having some preliminary discussions prior to this Buzz House podcast surrounding depreciation. So basically, I wanted to go ahead and start off by discussing what kinds of tax strategies do you feel are important in real estate with respect to depreciation, given all the things surrounding tax legislation, et cetera, that's either expiring or currently there, and give a brief description of what you think is what people should be doing right now to sort of maximize those benefits.
Yeah, thanks, Garrick. Thanks for including me. Pleasure to be here. Depreciation is such a powerful part of housing. And it's one of those areas where, there's so many components to the deals that we do that depreciation is often left unaddressed. And I wouldn't say that we wind up with unintended consequences, but we don't wind up with purposeful results. And so we have continued with our clients and and continue to really map out what type of losses are being created. We're in a current environment where bonus depreciation, which has been available since 2001, but is still in place now with 100% available to assets, that fit certain classes. And so, what does that mean? It means that when you put a, $10 million project in service, first year shelter could be 20% of that. You could have a $2 million loss allocation available. And so, Garrick, I think, that depreciation is incredibly powerful as long as you're thinking about who's going to use it, how quickly they're going to use it. For a better term, maybe just monetizing the depreciation that comes from these projects. If you take $2 million times a 30 or 40% effective rate, you get to some large numbers very quickly. So we continue to make sure that when these projects are being put together, that we know where these loss allocations are going.
That's great, Chase. It always amazes me the amount of tax planning in real estate, especially in multifamily asset class where the depreciation amounts can be so large, just how voluminous that benefit can be, especially with things like cost segregations, et cetera, that are out there that allow for that accelerated depreciation. What about things like other tax benefits that are out there? I know that there's a lot that are either expiring or the ability to do certain things with depreciation and net operating losses, et cetera, are expiring. Can you give us a little bit of a background on the types of tax benefits that you generally like to work with that you're seeing are very popular with real estate, either developers or real estate owners, and what we can expect for the coming new year on these things?
Yeah. Well, and I think that you bridge that really well with the depreciation, your mention of cost seg. So as we would likely know, the cost segregation study is engineers going in and looking at, and CPAs largely that are dedicated to this, that they'll go in and look at the different types of property and the classes that you can break a building up into, which then return a faster or accelerated recovery life on the dollars you spent. And so one of the provisions that has come out of the CARES Act is that individuals can carry back business losses for 5 years. And so what a great opportunity to take a look at cost segregation studies and depreciation and say, well, even though I put this project into service, a few years ago or multiple years ago, you still have the ability at any point in time to do a cost segregation study if you haven't done one and generate immediate losses. And so now that we have the ability to carry back 5 years, we kind of look back at our clients' tax paid. And if it was significant amounts, we go into current projects to see what might be available to be squeezed out and then carried back and instantly monetized for some tax dollars. So that is a really big push right now to make sure that, if there is depreciation that could have been accelerated, that we go back and grab it and carry it back and get some cash to use to get through these times. Some other provisions that have come on specific to housing, not just through the CARES Act, but is the 45L Energy Credit Act. And this is a $2,000 per unit credit that's available if you meet certain energy standards. And the energy standards are more likely to be met than you would guess. The standards are based on previous standards, and materials that we use now in building are just more energy efficient. And so you do have to get a certification, and there's a cost of that per unit, but you can go in and the consultants will kind of, test it for you just by looking at the plans and the type of furnaces and windows that you're using and come back and say, yes, this project can qualify, it has to be under 3.5 stories. And so there's a few requirements, but absolutely going back, this was a credit that had expired in 2018 and wasn't available. So there's a lot of projects that were built in 2018 that this wasn't even considered for because it was kind of revived after that. And so this credit is available for 2018, 19, and 20. And again, we're working with clients to go backwards in time and look at projects that have been placed in service to see if, maybe there's a credit waiting for us.
Great. Yeah. I mean, that sounds like something that people should be taking advantage of. And you mentioned it's $2,000 per unit. I would imagine, I did a little reading on it. Imagine it's for apartment complex units. Is that correct? In addition to sort of like single family homes?
You bet. Senior care facilities can qualify. Multifamily housing can qualify. Certainly single homes can qualify. So really the IRS defines it as a single dwelling unit. And so there gets a little wrinkle, and sometimes it's you can get granular. And even when we help some clients build in the senior care spaces, they might normally not put in a stove, if it's a memory care unit or there's some danger there. But we've worked with them on the fact that it would qualify for the 45L, the $2,000 per use, if it met certain dwelling requirements by the IRS. And in some cases they put them in, but they don't turn them on, even just to activate that credit. So it is something not only to look forward in going backwards, but energy is an area I think that we're going to see, some focus on, given President-elect and some of their, initiatives. And so I do think even in building stages, you'd be surprised how little you may have to spend on, the types of furnace that you put in just to kind of get over the hump of what qualifies in anticipation of these credits being available.
That's great. That's very informative. I think, it's a good segue actually, because as we head into this new year and we don't really necessarily know what might be changing, what types of planning do you think real estate owners should be thinking about? And I know you don't have a crystal ball, but obviously there's some policy changes that very well may take place. But what is your take on this new tax policy and how it'll affect tax planning strategies, or how are you working with clients right now to really sort of address that?
Yeah, great. Some great conversations have been had recently, and then certainly with the president-elect coming in, we have some vision as to what they've laid out as tax policy. So when we think about real estate, certainly capital gains rates is a factor in how we manage our portfolios, right? When we go to sell, it's really about the after-tax cash, what we're going to walk away with. And so capital gains rates are vital. So we kind of have this unique time where cap rates on the selling side and cap rates are low, interest rates are low, really kind of this unique storm of events. And then we look forward and say, okay, well, if there is a change in the capital gains rates, and there's been discussion of, you're over $1 million, could the cap gains rates go from 23% to 43%? Possibly. And so I think it's a great time to take stock in your portfolio and really look at your assets in a much more strategic way than maybe you're already doing. In other words, do you want to own that asset for the next 10 years? Because the ability to move in and out of real estate might be a little bit more handcuffed than we've ever been. There's also discussion that 1031 like-kind exchanges for real property, they removed the ability for us to do that with personal property in the last round. But there's a discussion that 1031 or like-kind exchanges for real property may not be available. So when we look at getting rid of property 3 years from now with no like-kind exchange available, a 43.4% rate. Now that's over $1 million, and there's some other caveats. But when you sell a building, a lot of times your gain, even though the cash doesn't follow, could be millions of dollars. And so we're really advising clients to kind of get ready to hibernate a little bit on the assets that they have in their portfolio. And if there's things that are not strategic, maybe look at kind of a strong market on what might be available for them to sell. There's opportunities to defer into opportunity zones, which you don't have an exit tax on. And there's just kind of some real dynamic strategic thinking, I think, that's available for, we have to look out, 10 years from now. I think that, there's a good chance that, like I said, getting rid of properties 3 years, 4 or 5 years from now may be really tough to do given some of the things we see coming through for tax reform. The other side to that, Garrett, too, is that bonus depreciation, which we talked about monetizing and so forth, that's set to change in 2022 and set to kind of decline. And so again, a lot of our abilities to come in and out of real estate have to do with maybe matching a sale with another investment going into service and really getting some shelter. That may not be there as well. So to me, a lot of the indicators say you need to look out a little bit further on what's strategic and what's not, and maybe make some moves.
Yeah, it sounds like a lot of planning and strategy that needs to be done. I know before we wrap up here, I believe Don might have wanted to ask some other specific questions since we got, you on the call, and this is all about tax, right? So
exactly. No, thank you, Garrick. No, and Chase, we were talking, you and I were on a phone call recently, and, I think this still comes up in many of our real estate deals, multifamily deals is TIF. And, without necessarily, opining on things, just maybe remind our listeners, be wary of TIF and structuring and so forth. We probably could have a whole buzz house on TIF structuring, but maybe just what to be cautious about when looking at potential TIF or other related incentives from municipalities.
Yeah, you bet. We did get a little bump to the system that we were used to. So for a long time, we were used to having a structure that allowed for non-member contributions, municipality governments to contribute money into our project and really not have a tax hit you until maybe disposition of that asset or some deferred period. And we still don't know if it was intended or not. It seems to be intended at this point. But when the Tax Cuts and Jobs Act came into effect December 22nd, 2017, they removed a code section that allowed for developers to take governmental monies into their projects tax-free. And so this has really been, and municipalities, and we, Baker Tilly has worked a ton with municipalities in all the areas that we're located, and furthermore, to find out new ways. But it is one of those situations where if you're just doing business as you have been, you could be surprised, and not pleasantly, by some income recognition that we didn't used to have to deal with. And that goes as far as, receiving property at a discount, buying land for $1. All those concepts, not that they're not available, but they need to be thought about differently and maybe analyzed differently than we have in the past, because of what happened in the 2018 tax legislation.
Thank you for that, Chase. That was really good information, really good things to think about as people come here to year end, look at, we have a new administration coming in, what should they be doing with their assets and so forth. So a lot of really good things. And so to wrap up here, we want to thank Chase for joining us in the Buzz House. Please reach out to Chase Inda. We'll have his contact information at our podcast site for any follow-up on any of these items, any tax strategies, and so forth. And listeners, thank you for tuning in today. Thank you for listening to Buzz House. To receive a notification when new episodes are available, please subscribe to Buzz House, a Baker Tilly podcast, wherever you get your podcasts. For additional resources around multifamily housing, check out bakertilly.com. And if you have a suggested topic, please send them to build@bakertilly.com. That's BUILD@bakertilly.com.
The information provided here is of a general nature and is not intended to address the specific circumstances of any individual or entity. In specific circumstances, the services of a professional should be sought. Tax information, if any, contained in this communication was not intended or written to be used by any person for the purpose of avoiding penalties, nor should such information be construed as an opinion upon which any person may rely. The intended recipients of this communication and any attachments are not subject to any limitation on the disclosure of the tax treatment or tax structure of any transaction or matter that is the subject of this communication and any attachments.